Different types of life insurance explained. In this educational episode, I'm going to address term life insurance versus permanent life insurance, cash value life insurance. Get ready. I'm going to simplify this, but hopefully it will give you a better understanding. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades. And clear back in 1974, when I started, I got my Series 1 securities license and also my insurance license. And I've helped thousands of people be able to prepare for long-term goals such as retirement by utilizing life insurance for living benefits. But let me explain some things to you, because back in 1974, I was a big buy term insurance and invest the difference proponent until E.F. Hutton came out with universal life in 1980. Prior to 1980, there was only term life insurance and whole life insurance. Whole life insurance was primarily designed for death benefit. But let me explain the differences here in this episode so that you'll begin to understand a little bit about how life insurance works, because all life insurance, term and permanent, all have a term insurance charge or component, the actual mortality cost associated with it, okay? So throughout the years, especially in my career, when I first started in 1974, the insurance companies were using the CSO, that's Commissioner's Standard Ordinary Mortality Table, based on 1958. So in 1958, the government put out the mortality tables. And back then, for 30-year-olds, the actual amount of 30-year-olds, if you took 1,000 30-year-olds, 2.13 would die that year. So that's called the mortality rate. Out of every 1,000 30-year-olds in America, 2.13 would be dead at the end of that year, okay? So that's called the mortality rate. Why is that important? Well, let's simplify this. Let's round it down to 2, because in 1980, they revisited because medicine and everything advanced, and so the mortality table came down to about 1.93. And then in 2001, it came down again in 2017, so it adjusts. But I want to keep this simple in this episode, so let's just round this to 2. Out of every 1,000 30-year-olds, 2 will be dead at the end of that year. So let's simplify and say that we have this fraternal organization, and there's 1,000 of us in this fraternity, and we're all 30 years old, and we're all males, okay? And we decide we want to provide a death benefit for the 2 who will not be here at the end of the year because they're going to die based upon these mortality tables. So we pass a hat around the room, and we're collecting money so that we could leave behind $1,000 to the 2, spouses or widows that we're going to leave behind. Let's say we're all married, okay? So how much would we have to contribute to the hat to end up with $1,000 for 2 widows, beneficiaries that will need some help at the end of that year? Well, we all have to contribute $2. We have to collect $2,000 to have $1,000 for those 2 widows. Does that make sense? Okay. And so the mortality cost might be $2. But see, if we continue to contribute money and pass around the hat every year, we're going to have to keep putting more and more money into the hat. By the time we're all 40, some of us will have been gone, and we're going to have to contribute maybe $3.50 at age 40 instead of $2. At age 50, we're going to have to contribute $8.32 because that's the mortality rate. And this, again, is based upon 1958. It's a little bit better than that now, but this is the concept I'm talking about. When we're all 60, about a third of us will already be gone, okay? The other 2/3 of us are going to have to contribute $20.34 to the hat in order to have $1,000 to pay out to the widows for those that will die from age 60 to age 61. Does that make sense? Well, at age 65, we've got to contribute nearly $32. At age 70, we have to contribute nearly $50. At age 80, we've got to be contributing almost $110 for that year. And at age 90, we've got to be chipping in $228. In fact, the 1958 mortality says that if you're 100 years old and you want to provide a $1,000 death benefit, you need to contribute $1,000, okay? Because you will likely die from age 100 to age 101 based upon that mortality table, okay? So hopefully this is making some sense. So what I want to do is illustrate the difference, because that's term insurance. But see, those mortality costs are inherent in every single insurance policy, whether it's whole life, universal life, or term insurance. So on this chart, I'm going to simplify it. Going up here is the cost of insurance, these mortality charges, okay? Across here is the age. So we're going to start out at age 30 like I did, and we're going to go every 10 years to age 100. So based upon what I was talking about, term life insurance is going to get more expensive. You're going to have to contribute more money on annual renewable term every single year, because I haven't filled in all the years in between here, in order to have that insurance coverage. If you were buying an annual renewable term insurance policy where your premium goes up every single year. So I'm just putting this on a straight line. It might be actually curving up like this, but I want to keep it simple here. So this is term life insurance. And so what I was telling people to do back in 1974 is buy this term insurance and invest the difference between that and maybe what you would put into a whole life insurance policy, which is more money, as you're going to see here. And if you put that into a mutual fund, and if you could earn 12%, you'll come out ahead, which was true mathematically. But then if you earn 12% and at the end of the day you had to pay tax, many of my clients who accumulated money were between a federal and state income tax bracket, paying 33% or more in taxes on the back end. And so if you earn 12, you're only netting 8 in a 33% bracket. And there might be fees and so forth. And so you had to earn 12 to net 7. The fact of the matter is a lot of people who have their money in the market aren't really earning 12. They're earning 9. And so if you're earning 9, you're only netting 6 after tax, and maybe only 5% after taxes and fees, okay? But the point is this, term life insurance, you're just paying for the pure cost of if you happen to die. Now, whole life insurance, when it was introduced, they said, hey, let's look at paying like $20 to $30 into this life insurance policy, even starting at age 30. Let's pay 20 or 30 bucks into this. And so you're way overpaying here the early years, because that's not the premium, the money you'd have to put into that hat until you were 60 or 65 years old. So you're way overpaying the early years. Why? Well, so that the 2/3 of us who make it to beyond age 65, we can keep paying that level premium of let's say $25 per thousand the rest of our life, so that we have a level premium. And so we're underpaying the later years because we overpaid the early years and we built up this equity. We overpaid. And so when you overpay, that builds cash value. And when that cash value grows, and the insurance company, actually, because they have physical exams, they do underwriting, and they actually eliminate probably 50% of these people who are going to die. And so they actually, the actual people who die that they choose to insure is less than the mortality, but they can charge you the full mortality cost. But if the actual deaths per thousand are only about half this or less than that, then the insurance company has excess money and they can refund that to you, but they call it a dividend. But it's not a dividend in the true sense of the word. A U.S. Treasury decision 1783 said dividends of whole life insurance are not really dividends in a commercial sense of the word. They're refunds of overcharge, because they charged you this, but not that many people died because they sort of screened them out when they underwritten them, okay? And so when they refund the overcharge and they call it a dividend, they're acting like, well, we're being profitable because we're only choosing to insure certain people. And so we're giving that dividend back to you, and it's a refund, but you can leave it in the policy, and this will build up cash, okay? And so you're way overpaying the early years so that you can underpay the latter years, and that builds up this cash value. And hopefully the cash value is enough that if you live to be 100 years old, the policy will not lapse. It will always be guaranteed to have a death benefit. So whole life insurance has guarantees to make sure that if you pay what they tell you to pay, for as long as they tell you to pay it, it's pretty rigid. Because if you don't do that, it lapses or it goes into a non-forfeiture option. It's very rigid. It's not flexible. That you're covered with your whole life. But it was designed primarily for death benefit. That's the chassis. Can you use the cash value for living benefits? Yeah, but it wasn't really designed for living benefits. That's what universal life was designed for in 1980. In 1980, when universal life was introduced, this was like buy term, invest the difference on steroids, and I'll show you why. But first of all, let's just talk about different types of permanent insurance. You could actually pay even more money into a permanent life insurance policy up to age 65. These used to be called life paid up at 65, but sometimes the guarantees weren't enough. And so, but the idea was, well, why don't you way overpay and you can stop at age 65 and the cash values and the dividends should be enough to keep you covered if you happen to live to be 100 years old. The policy won't lapse, okay? Well, some of those policies do lapse, and so they stopped saying, well, this is paid up. They didn't like using that terminology. But you could pay a higher premium and probably get away with paying no more premiums after, let's say, 65. Or what about you pay for 20 years? This used to be called 20 pay. So you pay even more into that permanent policy for 20 years, and because you have so much overpayment, the cash value is sufficient enough that it will likely keep the policy in force under worst case scenarios if you live to be 100 years old, okay? Well, then there was 10 pay. Well, they don't like to say 10 pay and 20 pay because there's some factors there that may make it lapse, but nonetheless, based on historical performance, maybe if you paid this much money in 10 years, then the policy would likely stay in force with the cash value out to age 100 if you live that long. And so that's how you overfund even more than paying a level premium your whole life. It's still called whole life. Well, in 1980, when E.F. Hutton came out with universal life, and then in 1997, indexed universal life, what a lot of agents don't understand is you're actually able to fund the life insurance primarily for living benefits. You're taking the least amount of insurance the IRS will let you get away with, and you're putting in the most premium or money that the IRS allows. So if you wanted to put in $500,000, my heavens, you could buy a ton of life insurance for $500,000, but my clients weren't interested in the most death benefit. They wanted the best rate of return on $500,000. They wanted the $500,000 to generate $50,000 a year of tax-free income. They wanted that $500,000 that they put into the policy to double to $1 million in 7.5 years, which it did. Why? Because they put in $500,000. They put in these large lump sums. They funded the policy in 5 years. Now, you can't do that with whole life. It takes at least 7 years. But you put in the entire amount in 5 years, and so you're way overpaying. Why? Because you're not interested in the death benefit. You're interested in that cash growing like crazy. Because you want the $500,000 to double to $1 million, and then to $2 million, then to $4 million, and to $8 million. And we've had clients that have experienced that. Or you want that $500,000 to generate $50,000 a year of tax-free income for the rest of your life. You do that by structuring the policy to take the least amount of insurance and put in the most money as the IRS allows. So that, in a nutshell, is the difference between term insurance, whole life or permanent insurance. Universal life is permanent insurance, but universal life was designed to accommodate even more money faster than whole life, and that's why it performs better. Okay? And I can show you all kinds of illustrations to prove that point. So if this is intriguing you and you would like to learn more, I would like to invite you to study one of my most recent best-selling books. It's called The Laser Fund. This is actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations of how a max-funded IUL, Index Universal Life, works. If it's structured correctly and funded properly, it is deemed a laser fund. Laser is an acronym that stands for Liquid Assets Safely Earning Returns. Okay. Now, if you're more of a right brain thinker or learner, you flip it over and you read this one. This is about 100 pages, 12 chapters with 62 actual client stories of how max-funded IUL can be used for all kinds of financial goals, such as retirement, college funding for your kids, working capital for business, real estate management, emergency funds, pension maximization, all kinds of various goals. It's the dream solution. If you want to use your whole brain, then read both. But this is a 300-page book. It retails for $20 on Amazon. If you go to Amazon and purchase, thank you, but I'll gift it to you, free. So if you want to claim your free copy, simply go to laserfund.com or go to laserfund.com. You contribute a nominal amount toward the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you and check out if you like to listen and learn and watch and learn. There's audio and video versions there. Check out the educational webinars we teach on a regular basis. They're free. You can even schedule an appointment with an IUL specialist that I have trained so that they can create illustrations with no obligation, no cost to you on how a properly structured IUL may benefit you so that you can use it for living benefits like I have for nearly 50 years.